day. Look at that. Just went green. Mm.
Good morning, good afternoon, wherever you're watching this. I am running without our producer, Sean, so give me 1 second as I hit live. We'll cut this off from most of our physicals, but... Good morning. This is Robert from Infonomics. My name is Zachary Faust, and today we're going to be going through what's going on in the precious metals market, as well as making sure that we're in tune on what's going on in the geopolitical space, because we know that affects markets dramatically. We had some Federal Reserve drama over the weekend that we're going to deep dive into. And honestly, like we talked about earlier before this even started, Rob, a lot of kind of confusion, not really seeing what we expected to see this Monday morning. So let's start there, brother. What are you seeing in the markets, and what's your take on it?
Yeah, so it is a bit confusing given what we saw with this recent indictment of Jerome Powell and the Fed.
Yeah, no one really saw that coming, but yeah, a little 2-minute video and 4 weird swallows later, we got not really a lot of movement in the markets.
Yeah, so S&P 500 is basically flat right now. And yeah, I mean, gold and silver, look, are definitely ripping, which you would expect. That part makes sense. The bond market is not really reacting how you would expect. If we look at, like, say, the 10-year Treasury yield, which I got right there, not moving. It's up like a basis point, but you're not seeing the bond market melt down the way that you kind of think it should. So that's interesting. And yeah, equities are basically flat right now. If we look across, Mag 7 basically flat on the day, equal weight flat on the day, IWM flat. Everything's basically flat. Rallied really hard off the open. So we'll go here. Boom. You can see this. We gap down way down here, just ripping higher.
What date was that?
This is all just today.
Got it. Okay, heard.
And yeah, up half a percent. Dollars down by 1/3%, which you would expect. So the announcement was here, or that was open.
So the dollar reaction to the news was weakening that dollar. Simultaneously, and I'm sure they're connected, I'll wait for your confirmation, we also saw precious metals rip up, or at least they have at the opening of the market now. I think silver's over $85 an ounce.
Silver, yep, 85. So really, like, there's two ways of thinking about the dollar. There's dollar relative to gold, right? Dollar in real purchasing power terms, which is significantly weaker, right? As gold is going up, the dollar is weakening.
Right.
So you could do, like, the other way to think here's the long-term chart of gold. The other way to think about that is gold denominated in dollars. The other way to think about that is this, which is the dollar denominated in gold. So, like, it's really important to look at gold in the right way. A lot of people, when you talk about the dollar in a situation like this, very emerging market like sort of thing, they're going to talk about the dollar relative to other currencies. So the euro, dollar euro, or dollar yen, those sort of things. Dollar franc is, by the way, the Swiss franc we were talking earlier. This is the only currency in the world really that is appreciated versus the dollar for the past couple decades.
Wow.
Going back to the start of the
data.
data.
The layman looking right now, just tuning in, that as that's dollar going down, that's the dollar going down against the
dollar down. Yeah, Swiss franc up. And so, yeah, it's one of the few currencies. It's actually backed. 50% of their currency is backed by gold. So they're one of the only, like, responsible actors when it comes to country, sovereign nations. So yeah, you would expect this. Look, back in early part of 2025 around here, I wake up very early on the West Coast. I'd wake up and I would see the franc is up, or dollar down, dollar down relative to the franc, and the yen and the euro, and futures would be down, and the dollar would be down, like DXY index, and bond yields would be up, bonds down. So you had dollar down, equities down, dollar down, equities down, bonds down. That is like textbook capital rotation. That is what you see when capital's fleeing a particular country. You're selling bonds, you're selling the currency that the bond is denominated in, and you're selling your equity exposure too. That's what you see when capital's fleeing. And I was starting to see it like January, February of 2025. Every morning I'd wake up and see those three things. Maybe not every morning, but a lot of mornings you would see the dollar down, bonds down, and equities down. Well, that is something to keep an eye on. That is the sell America trade that you'll hear them talk about on CNBC. That's what they're really referring to. Sell America would be global investors, which own about $65 trillion of dollar denominated assets. 65 trillion. So, I guess almost double the entire national debt, or double GDP for a year. That is how much on a gross basis the rest of the world owns of everything, right? Whether it be equities, bonds, kind of total exposure. So yeah, the sell America trade could go on a long time if international investors believe that, America's flirting with emerging market like sort of thing.
And if we go into like emerging market, seems like we're already walking toward that with the physical dominance strategies that we seem to be following. What does that mean for markets? Does that mean that we hold tight to silver because money flees away from the dollar? Simultaneously, as the dollar weakens, do we see melting up occurring in the stock market? What do you see? What are your tea leaves saying?
So generally what you see is anything denominated in the underlying currency that is plummeting is going to go up. So S&P 500, right, is a dollar denominated asset. If we look at the scale, it's denominated in dollars. You buy SPY with dollars. You need dollars to buy SPY.
To transact in the S&P 500. Got it.
Yeah, like NASDAQ is a dollar denominated asset. So generally those sort of things are going to go up, right? But if I'll just pose it this way. If the S&P 500 over the next decade goes up by 5%, over the next 10 years, right, goes up by 5%, but the money supply grows by 30%, did you make any money? That's a question I think a lot of people need to ask themselves, because what we're talking about here is the denominator starting to melt down, right? Yes, the S&P 500 is going to go up. I'll pose it a different way. What if the S&P 500 goes up 30% over the next 2 years? 30% over the next 2 years, but the money supply goes up by 60. You didn't make any money. You lost money, in fact, because everything's going up. Everything denominated in dollars is going up, but the money supply is growing at a faster rate. So you're actually losing. It's not holding its purchasing power. Yeah, you can sell your S&P 500 for more dollars later on, but in real like goods and services, right, denominated in strawberries and eggs and milk and rent.
I commonly denominate my value and my net worth in strawberries. I'm glad you brought that up.
I mean, blueberries, stuff so that people actually need. The S&P 500 didn't actually give you a positive return. It gave you a negative return. So, I like to denominate the S&P 500 in gold. It's not going to work with SPY because SPY didn't exist back then. But the last period of time in the U.S. that we had populism was back here. That's .com there, obviously.
The giant spike we just passed.
Yeah.
Got it.
That was .com. Here is
the dates. 81 to
55.
Okay.
55 to 81.
55 to 81. Okay.
And so
so we're seeing Nixon shock there. Okay. Got it.
Here, yeah. The latter part of the dump, but it really set a peak back here in 68.
Mm-hmm.
And from that moment, if you were in the S&P, if you bought the S&P 500 in 1968, at the peak here in 1980, you had lost 95% of your value. Now, that's denominated in gold. If you look at denominated in dollars, it kind of went sideways. See, you can see the green line showing in dollars. So if you bought here in 65 in dollars, look, yeah, you sell in 1980, you get basically the same amount of dollars.
And is that
I'll draw a line
showcasing
there.
that during that time frame of like the Nixon shock and that sell off, that as weakness was being found in gold, so too we were getting simultaneous weakness in the dollar, and that's why it kind of evened out? Or am I misreading that?
So what this is showing is the S&P 500 in dollar terms basically went nowhere from 65 to call it 80, 1980.
Okay.
In dollar terms, you put $100 in 1968, you get $100 out. The problem is that $100 would purchase you way less actual goods and services because of inflation during that time period.
Right.
So yes, in dollar terms, basically went nowhere for, I don't know, 15 years in dollar terms, but in gold terms, it plummeted in value. So you could pull up the CPI index, which this is the inflation index, right? So this, you can think of the orange line as prices, right? The CPI index is what they measure the rate of change on. This is equivalent to how average people feel inflation, which is through cumulative loss of purchasing power.
Right.
And yeah, during that time period from here to here, yeah, in dollar terms, it went nowhere. But in the
Real
problem
purchasing
is,
power versus what
yeah,
people are
like,
spending at the grocery store.
yeah, $100 back here is going to purchase you way more stuff than $100 here. So yeah, you didn't lose money in dollar terms, but the problem is that during that time period, inflation was so high. I mean, we're talking about Nixon shock, the 70s with the commodity shocks, right? Oil shock and all that. We're talking about a very inflationary period of time. Instead of CPI, I'll put the inflation rate. And we can see, of course, inflation peaked out here in 1974 at 12%. Then it came down to 5%, and it went up to 15%. So, yeah, so like you don't just because something is up or down or flat in dollar terms, you have to be very mindful of what denominator you're using. So, I would just encourage people, like, I denominate everything in gold. You could also use the CPI index, right? You could do something like if you believe that CPI is kind of on the right track, but maybe it undercounts inflation by 3 points. You do this, S&P 500 divided by CPI plus 3. You can. There are ways to do it. I think it's miscalculating that.
You misconfused my brain right there. So for the average person listening, then, like, obviously we can see historically when the dollar's weakening, which is what you're showing, two things typically happen.
Versus gold.
Yeah, versus gold. That the S&P 500 typically does well. The dollar could remain neutral
in dollar terms.
In dollar terms. But to that very effect, if somebody has money just sitting in their bank account, that money is losing value when these things are moving, correct?
Well, yeah, look, S&P 500 collapsed 95%. If you were buying the S&P 500 here, yeah, in dollar terms, you got a lot, basically all your money back in 1980. The problem was the money you got back in 1980 purchased you, I mean, maybe it wasn't 95% less goods and services, but it was significantly less. I mean, gold rallied hard. I showed the inflation rate. Inflation was quite high, right? So yeah, the question becomes, what are you denominating your life in? We have all in America had the luxury of being able to denominate our lives in dollars, relatively stable currency, no big deal. Yeah, there's 1-2% inflation, but it is what it is, not a big deal. The problem is we're increasingly headed into a world where that is not going to work. And I'll point out that the S&P 500 in dollar terms is up pretty nicely for 2025, right? But in euro terms, again, it's a euro is not not gold, right? It's not like a great store of value. Yeah, in dollar terms, the S&P 500 is up 17% ish for the year. But once you adjust for the weakness in the currency, oh, I miscalculated that.
Stay tuned, because I'm going to ask you about fiscal dominance. I'm going to ask you for like a Barney style definition after we look at this.
There we go. So denominated in euros, the S&P 500. If you're a European investor, right? You only made like 1%. So yeah, the S&P 500 was up 17%, but you as an international investor only made like 2%, 1%. So you could use the euro. I don't think the euro is a very good store of value,
Right.
or measuring stick,
Right.
or denominator, but the franc probably is.
Well, so tell me, okay, so give it to me, Frank. If we believe, and I'm going to ask you for a quick definition and then your coaching tactics, right? If you were to believe that we're on the strategic lily pads of fiscal dominance, A, what does that mean? And B, what are the ripple effects that come with it? Because if we start just printing out money to solve any and all problems, and I think that some of the Federal Reserve news we got politically kind of speaks to that we're walking more and more closer, if not already in this fiscal dominance phase. What does that mean, and what are the ripple effects that maybe people can cling on to as this inevitably happens?
Yeah, you're talking about a situation where the Fed is not acting in the best interests of inflation and their mandate, right, which is inflation and employment. You're talking about a situation where the Fed is acting primarily as a tool to allow the government to service the debt. That's fiscal dominance. So if we go to interest payments, it's not that one. It's like A01.
We'll find it.
Interest payments being about that's not exports. Interest payments being about $1.2 trillion per year. It's the fastest growing line item.
Oh my God, look at that.
So this is an issue for the government. And so
right after COVID just started rocketing.
Well, yeah, you have, of course, the hiking of the rates, which made it untenable, given the debt load we had going in. And of course, 2020, we increased the debt load by a significant margin. So yeah, the primary purpose of the Federal Reserve becomes to basically take interest rates low,
right,
so that the U.S. government can get this 1.2 down to 500 billion or 400 billion. We did this before. So here's government debt. Got all my stuff. Government is just crazy.
Guy runs a great YouTube channel. He's got all of his notes up. It's Infranomics. If you're listening and are like, where can I follow this guy?
Oh man, it always does this. It's like, I don't want to see. I don't want to see some random ticker called USGD. I'm trying to pull up the debt. Like
lots of graphs that exist out there.
Yeah. So debt to GDP in 1947 was 110%. And it came all the way down to 30%. Well, the way that they did that was fiscal dominance, at least back here in the kind of in the mid to late 40s, early 50s. That was fiscal dominance, where you had very low interest rates. The Fed balance sheet increased by like 10x or something crazy. The data for TradingView doesn't is not in here, but we had yield curve control. So the Fed would print as many dollars as was needed to keep interest rates below a certain whatever it was. I think it was 2% for the long end for the 10-year, and I think it was like 1.2% or so, like around 1%.
And we achieved that by adding money to the economy to service
literally just printing as much money as required to buy as many bonds as you have to buy. This is why the balance sheet went up like 10x. Buy as many bonds as you have to in order to suppress the interest rate, because here I'll do TLT. It's probably a good way to illustrate it. The bond yield being inverse to the price.
Correct.
So here's
the more valuable the bond, the lower the yield. The less valuable, the higher the yield. For those listening.
Yeah. So they're inverse to each other. So TLT, this is the price of a long bond. And then in blue is the 30-year yield. And you can see they're inverse to each other. So when the Fed is engaged in fiscal yield curve control, for example, they're going to be printing dollars in the form of bank reserves to buy as many bonds as they have to buy in order to suppress the interest rate. That's what they did coming out of World War II, and debt to GDP came down. You had inflation that was very, very high. I think TradingView does have data for some of that. Yeah, here we go. So, for example, in 1947, inflation was 19%. Yeah. So, there's consequence to it.
So what I'm saying is, so in the same time frame on the last graph, where we saw our debt actually starting to get managed and yields going lower and interest rates becoming lower for normal everyday people, it was only possible because we were just printing.
Oh, we were printing like ungodly amounts of money. Yeah.
So then, is that what we're walking into? And if so, again, that means in theory, stock market rips. Crypto
in
keeps
dollar
ripping
terms.
in dollar terms, but
everything's gonna rip.
So
everything's gonna rip. Home prices are gonna rip.
So holding the dollar is probably the last thing you want to do. You want it invested in these assets, like you said, housing, which nobody wants to hear is going to go up anymore. But
look, housing is not going to outperform gold, right? So housing in real terms, a lot of people don't know this, but it's actually never been more affordable. So here is the number of ounces of gold.
You heard it here first, guys. Housing's never been more affordable.
The number of ounces of gold to buy one house. And we can see it's literally at a record low, 110 ounces. That's all it takes. And this data goes all the way back to 1963, right? Wow. So, like, for example, here in 2001, it took 819 ounces of gold to buy one house. So housing in gold terms since that peak, like if you bought in 2001, your house has underperformed gold by 86%.
Wow.
So this will probably continue, right? In my opinion, like housing is not going to rip, 25% a year or anything crazy. There are structural headwinds when it comes to demographics, when it comes to net migration. They're all, it's not like the best thing to own, but yeah, in dollar terms, like if you look at home prices, they've basically gone up. So yeah, home prices are going to go up. The question is going to be again, is it outperforming your denominator? Whatever you want that to be, it could be gold. It could be, I would not recommend silver. I think gold is a good one. It could be, CPI index plus 2 or 3 or 4, something like that. The Swiss franc, is a pretty decent currency. It's not like 100% great, but Swiss franc, you have to, in a world of fiscal dominance, in a world of very emerging market-like sort of market behavior and monetary policy and fiscal policy, you have to change your denominator. We've had the luxury for forever of dollar, income in dollars, savings in dollars, everything in dollars. But that's going to change. So home prices will go up more than likely in dollar terms. In gold terms, they'll probably continue to go down.
Interesting. So if we follow the same path right now, if somebody's sitting on the outside, living with family, maybe saving for a home, it may be better to start building that home out of gold bricks.
The question becomes, like, is it going to outperform gold? That's really the question in fiscal dominance. Is your asset of choice going to outperform gold? Right. That is the only question that I'm asking myself for the next, however long, decade maybe. Yeah, look, they could do 20% inflation and 1% interest rates and do 2 years of that, right? Inflation's probably, 20% for 2 years. They could do that for 2 years, be over and done, right? We de-levered debt to GDP is down at like 80, right? Which is fine. They could do that. They could do, we're going to run inflation at 5% and cap interest rates at 1. Now you have a negative 4% real rate. That's going to take, 10 years or so. So they have options on kind of like how aggressive they want to be, how quickly they want to de-lever, but the end result is inflation's up. It was quite high. Look, it was no accident, in my opinion, that President Trump was talking about 20% GDP growth.
Because we've kind of seen historically that's possible.
Yeah. In fiscal dominance, that's what it was.
But that
In
came
19
but that came with, like you said, the insane inflation that followed shortly there behind, tailing it.
Well, nominal GDP includes inflation.
Got it.
Real GDP was, I think, like 5% at
Got
the
it.
peak. So inflation adjusted growth, real growth. Yeah, here we only have it from 1947 onward. That peaked at 13% in 1950.
Heard.
But nominal GDP is what they're talking about. That's the whole game. Nominal GDP is the whole game. And you take inflation, you add it to real GDP, you get nominal GDP. That's what they need to have at 20%.
And in this case, we're talking about printing money to buy up bonds and assets. One of which is to liquidate them or add more liquidity, but the others, it's going to lower rates. You're mentioning things like rate caps. A lot of people would argue, well, if people are having a hard time getting student loans, if people are having a hard time getting homes, cars, that lowering the interest rate is the answer. And of course, that drama is spilling over into what we just recently seen with the Jerome Powell news and the Federal Reserve being served papers that some people speculate it is largely a political move because he's not lowering rates. The argument, though, and what we can see historically is when that happens, inflation comes behind. If we do that, we will see home prices go up because there is more demand. We will see all assets inflate. We will see more money circulate itself into the S&P 500 because people have more dollars flowing around. So is that the inevitable path if we go down fiscal dominance? Is things just inflate and there's no way around it?
Yeah, the dollar is going to collapse. I mean, it already is. If you look at gold, the dollar's collapsing. Like again, sure, a lot of people talk about gold going up in price, but gold did not get more valuable.
Right.
Gold went back here when I was buying in 22, 23 at like 1800 per ounce. It was a shiny rock that has, thousands of years of history of being money. It was a nice, pretty rock that I could look at. That was it. Well, it hasn't changed. It's still just a shiny rock, but the price is more than twice what I paid.
Like 2.5x now.
It did not get more valuable. What is happening is the dollar
Is weakening.
is doing that. The gold market, there are more people, when the gold price is going up, more people are selling dollars to buy gold than are doing the opposite.
Right.
Think about it just intuitively. If you do not have faith in the dollar, what would you see? You would see people sell the dollar to buy something they have faith in. So what do they have faith in? Well, look at what's been doing that. It's gold, it's silver. Frank is performed, for 2025 performed for currency pretty good, but nowhere near gold and silver. So yeah, that becomes the whole game. Is like gold is ripping higher in price only because the dollar is collapsing. More people are selling dollars to buy gold or silver than are doing the opposite. Because think about it, right? If you believe in the dollar and you see gold up at 46, you go, oh, I'm going to sell, a couple ounces of gold to buy dollars.
Right.
Why would you do that? You would do that if you had less faith in gold holding purchasing power than you did in the dollar, and you want to transition from gold into the dollar.
Yeah, you've mentioned a couple times
inverse.
before that gold is like the insurance policy against the dollar.
Yeah, and like it's not really gonna make you can make money in gold, but like generally the scary thing is that gold over long periods of time generally just kind of holds value, right? Like that's what's scary, is that it's not like this is coming 100%, like a doubling of prices in the next 5 to 10 years is probably coming.
Well, then let's finish on this then. So we see clear and obvious steps toward we are liberating more countries in 2026. We see clear and obvious signs of fiscal dominance, which shows clear signs of inflation in the future. But when you talk about the dollars dying, I think a lot of people hear that and think, well, how long can this go on for? How long until it's too weak? How long until it's too scary to hold the dollar? Are we going to reach that point soon, you think? Or is it just too hazy in the crystal ball to even guess?
Well, foreigners own $60 trillion still.
Right. So it's not
Actually more,
immediate.
65. I mean,
Still
this
a
is gonna go
lot
on
of
a
dollars
long
out there.
time. Yeah, dollar-denominated assets, yeah. So this can go on a long, long time, and look, the fair value of like, people talk about Dixie,
Mhm.
the fair value of Dixie is probably 30, 35 on a purchasing power parity basis. Like, the dollar is grossly overvalued. And so, like, for example, back here, this was going into the Plaza Accord, the dollar was up, the Dixie index, comparing the dollar to other currencies, was up at 160.
Mhm.
But on a purchasing power parity basis of like what can a currency actually purchase in this country, in this country, in this country, comparing like to like, on that purchasing power parity basis, the dollar here at 105 was more overvalued than it was back here in 1985 going into the Plaza Accord, where we saw a devaluation,
Severe one.
yeah, pretty significant one at like 50%. So the dollar here in 2024 was even more overvalued than when the Dixie was here in 1985 at 160.
Interesting.
So, this goes to the kind of Mar-a-Lago Accord and a bunch of kind of structural things, but yeah, it can go on a long time. I mean, look, I think it's really hard to like buy gold right now. Buy right here, buy this.
What do you mean it's scary to buy that?
Um,
That looks like a completely normal, healthy graph.
yeah, like a lot of the move has already happened, in my opinion. So if you don't have any assets, like getting in, trying to get into
Is this still
stuff
gold?
now, gold, yeah,
Gold.
just
Okay.
shorter time frame.
Got it.
Yeah, it's hard, man. Like it's really hard to buy that
Yeah, to buy
because the
here
move,
after you see all. Yeah, yeah. Buying any
you
asset
know.
that looks like that, I get.
Like I would, buying here made a ton of sense in my opinion. Buying gold and silver in 2022, 2023, 2024, right? But like buying now, it's hard, man. It's
Right.
really hard to say that it's going to do this again, right? It's going to double again because it's already moved 150%. Gold does not do this. Maybe if you're used to crypto or meme coins or tech stocks, right? Palantir or something, right? Crazy, like high beta stuff, 150% over 2 or 3 years. No big deal. It's like, yeah, that's good performance, but this is not normal for gold to move like that
Right.
in a relatively short period of time.
Very.
So, yeah, like, is it going to do that again? Is it going to do another 150% and go to like 8,000, I guess, 9,000? No, I guess it'd be 10,000.
Good Lord. Yeah, because just doubled would put it at 9.
Yeah, there. So 100% is it's like, I don't know,
You can't
could
even
it do
scroll up high
that?
enough to get to
Um,
it.
yeah, no, for real. It's like it's insane. The one thing I will say, going back way, way back. So here, I think we showed this last time, but here is the Nixon shock, 1971, and gold ripped, right? Like the reason I always do this is so people can like put themselves in the moment and
Mhm.
see that things have looked very stretched before,
Because just to be
and it
clear,
just
what
get
you're showing right now on the screen is
I'm just scrolling
1971
through
to
the
like
gold price.
1979.
I'm just scrolling through the gold price from 1971.
Yeah, watch this.
Right? There's a pretty big drawdown. I think something like this is totally possible in gold. So you should, in my opinion, I'm staying unlevered. I'm not using leverage. But then look, it rips and breaks to a new all-time high. Right? It peaked out here at 193, went down to 99,
Which is a
and then
huge drop.
this is a pretty big drawdown. Yeah. And then you rip higher, go parabolic up to 420. Actually goes all the way up to 800. You draw down to 400,
Another
80,
insane drop. It's like a 40%.
another, 30, 40. Yeah.
Yeah.
Right. So it can always get crazier, but there's going to be volatility. It can always get crazier. A lot of the market has priced in a lot of this stuff already. And so buying gold now, the risk reward calculation is a lot different than it was in 2022, 2023, 2024. So
Now,
it's really hard.
can you go back
Um,
to can you go to the full graph and just put your marker on where that parabolic rise in the 70s was? Just so we can see how small it is in comparison now.
yeah, right here.
Like that's crazy. That puts this rip in perspective.
Yeah, I'm not using leverage because there's a popular chart that goes around every now and again of gold in Weimar currency units,
Weimar?
Weimarks,
What's
whatever
Weimar?
they were. And it does the same thing,
Right.
right? Like you have like 200% rip, 80% drawdown, 300% rip, 60% drawdown. Like there's a ton of volatility when these sort of major events, currency issues, fiscal issues, reordering, whatever you want to call it, fork turning sort of stuff. There's huge amount of volatility when this stuff happens. So using leverage is insanely
And
dangerous
that's
in
like
my
margin
opinion.
investing for those in the room. Yeah.
Margin, debt,
Investing money you don't have.
yeah, like credit.
Credit.
I knew people that were buying gold with credit cards, that kind of thing. Because gold has to outperform 30% or 25% or whatever your interest rate is. Gold has to outperform 25%,
Jeez.
right, for you to make money. Because otherwise, the cost of servicing the debt on the credit card is more, right? So, yeah, using credit cards is definitely not smart, in my opinion, to buy gold or any asset. If you can get fixed rate loan, smart. If you really know what you're doing, and rates are low, right? You're incentivized to borrow money. It can be smart to borrow at low rates and invest that money in a well-performing asset. But leverage carries risk. It amplifies return, but it
Big
also
time.
amplifies downside,
Right.
right? Like they're the BTC backed loans, right? That are kind of structured to do that, where you low LTV, I think is key. I know people doing like, 30% LTV, right? So you put up $10,000 of collateral, they give you 3, right? So very conservative, at like 10% interest rate. Well, if you put that back into BTC and it goes up 20%, you just made money. You amplified your return. This is what housing is doing for people, for Gen X and boomers and all them.
The boomers.
They got to enjoy levered exposure to currency debasement because we showed that home prices in gold terms are actually down. So all that equity, right? If they bought a house at 100, they probably only put, it's like 10-to-1 leverage. That's really what housing as an asset really
Right.
is
And
your
sometimes even more so when you're taking on only a 3.5 or 5% down payment, the amount of money. And
yeah.
that's how real estate investors make so much money. It's levered, but it's levered against kind of exactly what we're talking about, inflation.
Yep. Yeah. So the home is going to go up as inflation goes up. As the dollar goes down, your home price is going to go up in dollar terms. And, if I have $10,000 as a millennial, I could go put $10,000 on a down payment on a $200,000 house, get 20-to-1 leverage, right? Or I could put that $10,000 in the S&P 500 or NASDAQ or BTC or gold or something, right? But the return that underlying thing would have to give me to equal, right? Because if your home doubles in value, you only put up 10 grand, but you now suddenly have an asset that you can tap with a HELOC that is, you just made 500,000 or 400,000 or something, right? So that's why housing, it's really just you're getting levered exposure to a relatively scarce asset. Now, does this administration really go hardcore on increasing housing supply and we actually get a correction in home prices? It's possible, right? So even buying a home is not super. Nothing right now is 100% safe. Nothing right now is without risk. Like it's a really difficult time. Speaking as someone who's trying to navigate these waters, like I'm holding my gold and silver that I was buying back then. I'm holding it. Like I'm not planning to sell anytime soon. I don't own a home. Buying a home now is risky, in my opinion. But then on the other hand, it's kind of risky to not buy a home, right? Because if home prices do double, because we get fiscal dominance, inflation 20% a year, 10% a year for 5 years, something like that, home prices are going to go up a lot.
Dramatically.
Right. So there's all sorts of, there's really no like anyone that is telling you right now in this kind of era, in this landscape, that there is 100% sure bet is lying to you. It is incredibly risky. There's a huge amount of both right tail risks and left tail risks. It's a very difficult time to try to navigate money. I think the one thing I would say is that in general, the only time the dollar actually goes up in value in terms of things you need for your life
Blueberries.
is during, blueberries, haircuts, cars,
Like you went
is
from
dur-
blueberries right to haircuts.
is during deflation,
Right.
right? So if we look at like the purchasing power of the US dollar, this is the Great Depression here.
Mm.
And the dollar actually gained purchasing power a lot too. From 1920 to 1933, the dollar gained 66% purchasing power.
And that being, I assume, due to the low
Deflation.
supply of dollars at the time, that, like you said, deflation.
Deflation. The economy shrank by like 40%.
Yeah.
You know, it was a huge, crazy deflation, but dollars went up, right? Dollars bought you more stuff than they did in 1920. Very, very rare, as you can see from the chart. What is much more common, the mega trend here is an asymptotic curve to zero. That is what is that is generally the thing to bet on. Now, if you think a Great Depression is coming to America, then the next question you need to be at, because there's a lot of people saying that. I don't think they've thought it through at all, but a lot of people, especially on YouTube, right? Like, oh, the 30-year Great Depression, it's gonna crash, the all that. The next question has to be like, okay, well, then what happens to the deficit? Because the deficit as a share of GDP in a recession goes up by like 800 basis points. You're talking about 15% deficit. Well, yields are probably going up in the face of that much bond supply. Like second and third order effects, second, third derivative, those people do not think of. So the point being that deflation or recession or those sorts of things where you do get deflation, those would be a margin call on the government, on the debt,
Right.
on the sovereign balance sheet. So it's very unlikely that we get that. And if we do get an economic contraction, like a recession of some kind, an economic slowdown, they will come in and print so much money. This is why people joke like the most bullish thing for gold or BTC or something is a recession. Because yeah, you get that first dip, but then they're going to print so much money
gets turned on.
because they have to.
Yeah.
Yeah, because they need to survive. And so that's kind of where that saying comes from. I mean, going all the way back to 1910, this is over 100 years of
The dollar.
history.
Yeah.
What is the mega trend there, right? Do you really think you're going to catch the one decade where there's deflation? And again, debt to GDP now is way higher than it was back here. So if this were to happen today, again, they would have to come in and print, like I'm talking like 10, 15 trillion dollars.
Jesus Christ.
Right.
That's
Yeah.
that's
Yeah. No, like
It's 15
if-
million millions. Jesus Christ.
if that were to happen, right? If we got a Great Depression like shock, they would print at least 10 to 15 trillion, at least. Just because of the math. I mean, the math is very straightforward. I've done it many times on X and my videos. The math is very straightforward. So yeah, like this is why I have an issue with those like perma doomer deflationista type people, is because they're not doing the math. And the mega trend is the dollar has lost an obscene amount of its purchasing power over the past 100 years.
Right.
97%. Right. That's the mega trend. And it's probably only going to accelerate. By the way, you can see the acceleration that we've been enduring for the past 5-6 years.
Post 2020.
Yeah, you can see that reflected. This is purchasing power of the dollar. You can see it was following kind of this, gradual sort of pace, and then it just like went straight down. That was the great inflation in 2020. But look, like just to put it in perspective, I know a lot of young people probably watch you got the millennials like us. 45% of the dollar's purchasing power has been lost just in the past 25 years, right? So imagine your high school, 2000 dot-com bubble, 9/11, right? That time period. Just going back to 9/11, the dollar has lost half of its value, purchasing power. So yeah, it is much more likely, in my opinion, that the dollar continues to lose purchasing power. Now, look, I don't think we're going to get a hyperinflation like Venezuela. here, by the way, is showing their economy shrunk by 70% going back to Maduro. I don't think we're going to get a hyperinflation where the inflation is literally so high that it breaks my chart. So at the peak, inflation in
Oh my
Venezuela
God.
was 130,000%. The only way that you can like really like analyze it is to look at it in logarithmic form. But yeah, inflation here 400%, inflation here 120,000%. We're not getting that. Right? We're just not. People that tell you hyperinflation's come, it's very, very low likelihood. Is it possible? Of course. I would give it less than half of 1% chance that you get a hyperinflation. You really don't want a hyperinflation. If you love your country, you love your family, you don't want this. This is very, very bad. You don't want hyperinflation.
Right.
And you don't need hyperinflation to going back to fiscal dominance and the debt and kind of what their game plan is. You don't need 150,000% inflation. You just need 5%, 6%, 7% for a decade. That's it.
Little
And
by
cap
little.
rates, of course, you need to make sure interest rates are not 5, 6, 7%, which is what the bond market is going to want to do in the face of higher inflation. I think the CPI print tomorrow is going to be very, very important. I think generally the pace of inflation is headed higher, not lower. We're already basically at 3%. The last CPI print, you cannot believe they literally imputed like half of the data.
Right.
It was just guesses. So can't trust that 2.7. Every legitimate read on inflation is 3%. I think it's much more likely over the next year that we go to 4 than it is that we go to 2.
Jeez.
So yeah, and look, we know the data is vastly underestimates. This is a good chart to illustrate this concept of just because it's going up in local currency terms doesn't mean it's actually gaining value. Here's the Venezuelan stock exchange, which a lot of people are posting, because as you can see, going back to August, it is up 1,000%. Going back just the past,
Missed out.
what, 4 months, 5 months. But once you denominate the same stock market in dollars and adjust for the currency, it's still up 230%, right? It's still performing quite well. But once you adjust for the
Gold.
loss of purchasing power in gold terms, it's down by 64%. So again, it really depends on what denominator you choose
Yeah,
to
'cause the gold's this
denominate
red
your
line
life.
that runs across the bottom, green dollars, and then is that Bolivar?
Bolivar. Yeah.
Bolivar. So let's put a bow on this for anyone listening. I'm gonna give a quick little final take, and then I want you to take the mic for a couple minutes and give yours. We saw news come out of the Federal Reserve, Jerome Powell. There's sanctions against them about the budget around the building. A lot of people say, okay, he's kind of stuck between a rock and a hard place with his interest rate decisions, and he's done the best with what he's got, which a lot of lagged, a lot of markedly underreported data, especially in inflation. And a lot of people would say it's political because he hasn't lowered rates. But if we were to lower rates and we were to print all this money, inflation would be shortly behind, and that could be the game plan. Secondly, we are seeing more money leave our economy and go into the dollar and silver and copper and platinum and all these other precious metals. And with that being said, it's just weakening our dollar consistently and constantly. And as we ended our conversation there, you heard, and this will be on YouTube if you only caught a part of it, as you heard there, the dollar is on a macro path toward death. When you pull the map back and really go and see what it looked like pre-World Wars versus today, what it looked like through the Great Depression, as of today, it's clear and obvious we're heading toward that path. Yeah, there's that graph again. That clear and obvious path toward doom. So making sure, if I were to give any investment advice, even though I'm not a financial advisor and you shouldn't buy, sell, or invest anything based off either one of our takes, is you don't want to just have a savings account full of dollars. You want to be levered with assets. Talking about housing, if you hold housing, these precious metals, even crypto, the stock market, index funds, even holding a bond right now is more valuable to hold than just simply holding the dollar, simply due to the inflation. And we just got done a good 45 minutes of deep dive on what's going on and what you can do about it. This is Robert from Infonomics. Go follow his YouTube channel and X. Fantastic updates I'm going to bring back up his chart. And Robert, I'm not even going to ask a question. I'm just going to let you finish on what you think more people should know as of right now, what's going on in the economy, what they should do with their own funds.
Yeah. So whether it's with Jerome Powell, like, look, the Fed independence thing that a particular party and look, it's all BS, right? Like the last administration was really who eroded Fed independence. Secretary Janet Yellen, through the issuance of so many T-bills, which are short-dated debt instruments, she already tied the hands of the Fed back then, right? In the last administration. The overall direction of Fed independence has been going in the wrong direction for at least 5 years, at least 4 years for sure. So the you only get this sort of structural change when it comes to Fed and Treasury and monetary dominance versus fiscal dominance. You get that like once every 70 years, right? If you go back to the last time that we got a major shift like this, it was 1951, and it was going the other way, which was we were going from fiscal dominance, right? We were showing all the charts 1945 up through the 50s. We went to monetary dominance. We went from high inflation, high nominal GDP, or financial repression, which is a fancy way of saying bondholders get wrecked. We went from all that to the world that we know now of monetary dominance. Well, 70 years later, we're going the opposite direction. And this is very consistent with Peter Turchin's work and Neil Howe and the fourth turning and all that kind of structural demographic theory. Very consistent. Interest rates and broader kind of monetary cycles move in these kind of 70-year big cycles. So it is what it is. We're in a fourth turning. The debt load is unsustainable. The only way that the math checks out, and I've done the math, it's pretty simple math, but I've done it many times. The only way the math works out is higher inflation. They cannot allow for interest rates to move much higher than they are now. They can't hike rates now, because if they hike rates, they're going to blow that 1.2 trillion out to 1.5, 1.6. That means more bonds.
The debt we owe as a country for those.
Yeah. So they can't hike rates
on the debt specifically.
They can't hike interest rates. Like the Fed independence and the ability for the Fed to operate as we've known for most of our lives is gone. Already gone. It's already gone. Because again, what's the consequence if we get, just envision this, right? Like play the thought out. If we get 5% CPI tomorrow, the Fed can't hike rates, because if they hike rates, it's going to take that 1.2 trillion up to 1.4, 1.5, because again, all of our debt is being issued in these short-term treasuries, which just follow the Fed, right? The yellow line here is the 3-month T-bill. This is what we're issuing all of our debt in. And as you can see, it just simply follows the Fed. Whatever the white line is doing, the Fed, the T-bills are going to follow, right? So if they hike interest rates, it's going to push the white line higher, Fed funds. It's also going to push T-bills higher. Well, T-bills, if we're rolling our debt every 1 month, 3 months, 6 months, that means we're going to have radically higher interest rate expense within short order of a Fed hike, right? And what does that mean? Higher interest expense? We don't pay interest out of like tax revenue or something silly. We issue more debt to pay the interest on the old debt, right? So now we're issuing more debt, more bond supply into, constant demand, call it. Well, that means higher yield, lower price, lower bond price, higher yield, right? So that's a debt spiral. So they can't hike rates because we're issuing so much of our debt in T-bills. They're trapped. They're trapped, whether it be the Fed, the Fed and the government, right? Like think of it all kind of, one big thing. They're trapped. The only way that they can really mathematically get out of this is either a productivity miracle. I will point out productivity is ripping higher significantly over the past 2 quarters. But the productivity miracle can't cause mass unemployment, right? The productivity miracle could theoretically fix the debt and the math without high inflation. That is technically true, but it is like trying to thread a needle that is 100 yards away from you with a shoestring. Like is it technically possible? Yes, but is it likely to work? Much, I give it a 2, 3, 4% chance, right? Because the productivity, as we're seeing, is causing unemployment issues.
Right.
Well, you have unemployment issues. How do you fund all their benefits to survive? The UBI, the unemployment, whatever you want to call it, Medicare, Medicaid, health insurance, right? How do you fund all that if right? So you very quickly realize that this productivity miracle that theoretically could fix the debt and the fiscal issue, it has to come at exactly the right pace, can't come too fast, too slow, and it has to come at just the right magnitude.
Right.
It is an
And
impossible
that
task.
productivity is automation, AI,
AI,
robotics, a lot
yeah.
of the things that are going to be kicking people out of the labor force. But the
Yeah.
caveat to your, like you're saying, the small percentage chance of if it's not a meteoric hockey stick rise, and the theory that there's going to be new jobs created with this new sector created. That's that small percentage point you're talking about of the possibility.
Yeah, that it all works itself out and fixes the debt, fixes the fiscal situation, everything works out.
But small
Very, very
percentage.
low likelihood. I understand the techno optimist crowd, the e-acceleration folks, like they think the singularity is coming and money won't matter, right? And like,
Yeah, I've seen
if
that
you
one.
believe that, that those I choose not to engage with all that. It's kind of nonsense in my opinion. But yeah, there is that crowd saying that, and it is technically true that you could theoretically get a productivity miracle that addresses the debt in a non-inflationary sort of way. That is technically possible, but the math is just so tricky right now that they are so trapped, both again the Fed and kind of the government, and it doesn't matter whether it's a Republican in power as it is now or a Democrat, right? This is
Preach,
the
brother.
math is going to stay the math. This is why I was calling for all these things like fiscal dominance and erosion of Fed independence. I was calling for all this stuff before the election because it didn't matter if Kamala Harris won or Trump won. It was going to happen because the math dictates math behind, the largest market in the world, the U.S. Treasury market. The math dictated that it must happen, right? So like none of this stuff has anything to do with politics. The math is the math, regardless of who wins the midterms or the next election or any of that nonsense. Like it's all just noise. The way they go about spending the money is different, right? But we have right-wing populism right now, and we're getting left-wing populism in New York, and right. That's the other thing is like not only is the Fed and the government trapped when it comes to the fiscal math, but then you also have, because of the silent depression and the fact young people can't afford homes and birth rate is plummeting, because of all decades of these horrible policy, you also have now a rise in populism. Well, what is populism? It's spending a bunch of money. Well, spending money is very inflationary, right? So like you're running into a lot of issues right now, and none of them are pointing in a good direction. None of them are pointing in a direction of, oh, yeah, 1% inflation and 3% GDP and the stock market does okay and no volatility. Nothing is pointing in that direction, right? The like 2008 to 2019 era where we had kind of low inflation, relatively okay GDP, and stock market just kind of went up, very low volatility. Nothing is pointing in that direction. Everything is pointing in higher volatility, higher inflation, and the volatility is not just market volatility. It's going to be social volatility, political volatility, that sort of thing, unfortunately.
Yeah.
So, what I'm choosing to do, or the way I'm choosing to navigate this, is by saving in scarce assets that can't be printed, that I can take with me if I have to, that I could take over border, that I could take over state border, God forbid I have to flee the country, right? You want to have bearer assets. We used to have bearer bonds, right? Those are dollar denominated, so maybe not the best. But you want something that it is worth what it's worth. Whoever, whatever person is holding that thing owns that value, right? And there's very few, Pokemon cards are technically a scarce bearer asset, right? And what do you know? They've outperformed the stock market over the past couple of years. Now, I'm not saying, right? I'm just using that as an illustration. Gold, obviously, silver, obviously. If you have $100,000 net worth, you can't really flee with silver. Even gold. I mean, $100,000 of gold is kind of a lot, like space weight, to hide it, right? If you have to get across a border or something.
So yeah, these are the sort of things, land is probably going to do all right. Like I would, if I had the opportunity, and I am kind of moving in this direction, to buy land, buy a house, that is something I would do. Because yeah, you're getting levered exposure to a scarce asset, a relatively scarce asset. And again, you look at the incentive structure of housing, right? Boomers, the median boomer has all their wealth basically in their house, right? So yeah, the average boomer is obscenely wealthy. But when you look at the median boomer, they're actually not wealthy at all. They have less than $55,000 in stock. The vast majority of boomer wealth is in homes. So if you do bring on new housing supply, you impoverish the boomers. Is that a political decision that any politician's willing to take? Probably not for another decade, right? When they're all gone. Then maybe, right? But I'm willing, it serves a utility purpose. You are getting leverage. So if homes go up by 1% or 2%, you're actually, if you're levered 10 to 1,
And you
you're
have a
getting more
place
than
to
that.
live at the same time.
And you have a place to live that's safe, right? I think where you choose to live, I think skills are really important. Having useful skills, especially given the age of AI and all that, I think that's really
Use the
important.
hands. Yep.
Learn how to change spark plugs, that sort of thing. And I also think that like location matters, right? Start thinking about location when it comes to I live in California, and we're seeing record wealth flight with this proposed wealth tax. The budget in California is like near a crisis. They cannot afford to have tax revenue go down because all the people paying the vast majority of tax is paid by the top 1%, in dollar terms, right? They pay a very low share of their wealth, but the vast majority of tax revenue is paid by the top 1%. Well, they're all fleeing California, right? So do you want to be in a state that is arguably going into a budget crisis? Or would you rather go to Wyoming, where they have a budget surplus? And not only that, they have a sovereign wealth fund, right? All the oil revenue was put into this kind of sort of sovereign wealth fund. So Alaska has one too, right? Those sort of thoughts. Same thing, with the city. Do you want to live in Los Angeles, where crime is out of control, homelessness, filth, decay, right? Like you can't. All these sort of things, I think you have to think about over the next decade. It's not just about I think there are much more important considerations than, oh, let me buy the dip in this and hope it goes up in dollars, right? Like there's a lot of like much deeper, more important issues like family, making sure your family's safe. These are what I'm thinking. Yeah, I got my gold and my silver and my BTC, right? But like what I'm really worried about is the gold price going up. What I'm really worried about is like, where am I going to live? Where am I going to buy a house that is going to be safe from potential racial issues, divisions, potential political polarization, potential secession from I mean, all this stuff would sound crazy to someone, in 2006.
Just 10 years
right?
ago. Yeah.
Yeah. 10 years ago in 2016. I mean, it was kind of starting to get a little, but those sort of things I think are, personally, gold, silver, BTC are my bet.
Right.
But I think home prices are probably going to go up, and I want a safe place to live with a good community and a scenery that brings me peace.
Yeah.
Right. I want to live somewhere pretty with clean air where you can see the stars. Right. Those sort of things, like that's worth something, right? Yeah, it's not a trade that we can pull up on a chart, but family, community, faith, those sort of concepts are worth a lot.
Amen.
Right. So I think that, I get very down a rabbit hole when it comes to markets and prices and charts. But it's important to zoom out, take a step back, and realize that, like, arguably what's way more important than that, especially probably over the next 10 years, is family, faith, community, that sort of thing, relationships.
Amen. The spirit, the body, the community. All
Health.
right, dude. Yeah, health. Absolutely. So we'll leave it off there. We got a lot of questions coming in on the live, so I'm gonna stick around and answer some of these. But dude, thank you as always each week, giving us an hour of your time and making sure we're up to date on what's real, what's in the numbers, what's in the graphs. I think it's really important, especially like you said, the math of it all. So I appreciate you, dog.
Yeah, anytime.
All right, brother. We will talk soon. Guys, give me a quick minute. We'll make sure we get this shut off properly, and I will stick around on the lives for Q&A, specifically on the TikTok side. So I saw quite a few coming in, so stick around. But if you want to follow this man, it is Infranomics on YouTube and X. I'm going to go stop the recording, brother. Have a good one, man. You can jump out whenever you feel, all right?
All right.
I'll
Sounds
I'll
good. Have a
catch you
good one.
later.